Hello, this is Steve Malone with CompassFX. Hope you're doing well today and you're getting some good trades. In my video series about trading with the pivots, I've spoken quite a bit about various pivot tools and how to trade the pivot for intraday traders. But what about those longer term traders, those swing to position traders? What ways can they use the pivot tool? Well, today I want to share a way of using the pivot compared to another pivot, and then I want to talk about another pivot that you can use referred to as the pivot range. Now, for those of y'all not that familiar with the pivot, again, the pivot is typically the previous day's high, low, and close added together and divided by 3. Then there are calculations off the pivot that give you 3 levels above, known as the R1, R2, and R3, and then calculations from the pivot below that give you the S1, S2, and S3. So all in all, this is what you have on a normal intraday perspective of the pivot levels. You're basically, again, taking the high, low, and close of the previous day to calculate this level for the day, known as the daily pivot. And we talked about also that when the market trades above the pivot, you have a long bias. Then the market, as it moves up and down through the pivot, back and forth, you go through a transitional phase. When the market drops below the pivot and closes lower, then you have a short bias. So again, a long bias and a short bias. The same is true for long-term traders. But how can you use the pivot as a long-term trader? Well, one way to do that is to compare the daily pivot to the weekly pivot. At CompassFX, we do have, in our mix of MetaTrader 4 indicators, we do have a weekly pivot tool. It's simply the weekly pivot _ CompassFX. If you applied this to the chart, you will notice that in the right margin, you have your weekly pivot levels. Now, as a longer term trader, something to look for is to compare the daily pivot to the weekly pivot. When the daily pivot is above the weekly pivot, your bias is long. When the daily pivot is below the weekly pivot, then your bias for the market is short. Now just remember though, going from a long bias to a short bias, you may go through a transitional phase. Well, that helps somewhat, but it may not give you a very clear picture. Well, let me share with you that there's what's known as the pivot range. Now the pivot range is also based on the high, low, and close, but instead of being for the previous day, it's over a period of days. And a pivot range has a high limit or a resistance level and a low limit known as the support level. So instead of having your intraday pivots compared to the weekly pivots, one thing you could do is simply put on a 3-day rolling pivot. And at CompassFX, one of the tools that we offer is known as the ACD 3-day rolling pivot. And this is based on Mark Fisher's book, The Logical Trader, and he shares a specific technique known as the ACD technique for trading the pivots, and he uses a 3-day rolling pivot. And what it does for the longer term traders is it gives them a clearer picture of the bias of the marketplace. So if we see in this case right here, you can see that over a period of time, it's much easier to see that over this 4-day period, the bias is long, and you notice how this resistance level was tested, the market pulled back to a pivot, moved up above it, and in this case when we get a breakout, that's a potential entry long. So we have a long breakout of this range here. Market moves up, stays up above, and it updated, and today we are moving back down, and we hit the pivot of the pivot range, bounce back up off the pivot range, test that previous resistance, and this is the area in which we're kind of fluctuating in. A little bit cleaner for those longer term traders. If I move out a little bit and see the bigger picture, you can see that it too goes through a transitional phase. We had a long bias for a few days here, a long bias. We went through a transitional phase right here, and then a short bias. Market pulled back up. Now, if you're looking at this from a point of view of trading, the pivot range can be used 3 different ways. First, it can be an entry on a breakout. So when the market tightens down or we move through an area, like in this case, we tightened down, we bounced along this, and then we broke above. There's a breakout right there and an entry point. Now the market moved up, came down, tested this resistance, which acted as support, and the market bounced off of it. It got tested again. Now as the market moves up, you can use a pivot range as a trailing stop. Let me show you what I mean by that. If we go over and take a look at the Kiwi, we can see that the market did exactly that. We can see that this rolling pivot, this 3-day rolling pivot, you can notice that it continued as the market went into the little range here. It broke out, and you could use this pivot literally as a trailing stop. You notice how the market came back down, tested, bounced off of it. During the next day when it updated, went back in a little bit of range, but then pushed out for another potential entry or add on to the Kiwi trade you might have been into. Now today we saw a pull back into the range. If we break below this, we may have a situation to where now we have a short bias in the marketplace dropping below the pivot range. So in a nutshell, the pivot range gives you 3 things to consider: an entry on a breakout scenario, or maybe a bounce. In this case, you can see that we went into the range and we broke out of the range, so we have a nice little trade. Second of all, it can be used as a trailing stop. And you can see even here, when the market bounced off of the resistance level, the resistance of the range acted as support and the market pushed on up. Another way you could use the pivot range is simply look at well-defined support and resistance levels. And you can see that as the market progressed to the upside here, it came down and it tested this area. When they all came together, in this case, the pivot range high, low, and the main pivot level acted as a very strong support level for the market to work off of. And when you trade, taking a look at this, here was a breakout short. When you trade this, as the market retraces back, again, support here acting as resistance, market tested it for a while and pushed off of that. Okay, but then as the market pushes back in, closes inside the range, then this could be considered your place to stop out or exit the market. So all in all, the pivot range may be something to consider. Now the tool that we use in this case is simply the ACD _ 3-day rolling pivot, and you can find it at this website, or simply go to the Compass FX homepage, click on the icon MetaTrader 4 indicators, and you will find this indicator. You can set the range start time and end time per day. It's flexible. You can show the pivot if you want to. If you select that false, you won't see the pink colored pivot. You can change the colors, and you can change the thickness of the line. So again, for those of you who are long-term traders, a couple of ways you can use a pivot is to either use the weekly pivot compared to the daily pivot, or use the pivot range tool, which allows you to see a bigger picture and let the pivot range be used for a breakout trade entry, assess well-defined support resistance levels, and run along the trend of the marketplace to be used as a trailing stop. The beauty of the 3-day rolling pivot is its simplicity. When the 3-day rolling pivot range is below price action, trade long. Long trades are favored. And when the 3-day rolling pivot is above the market, in this case, then your bias is short, and short trades are favorable. Well, folks, this is Dean Malone with Compass FX. Hope some of the information I've shared with you about the pivot range for you longer-term traders, I hope it will help you in your trading. Y'all make it a great day. Get some good trades. We'll talk to you next time. Bye-bye.